I'm normally prevented from talking about politics at GAAP Dynamics. That's because my handler, Chris Brundrett, usually muzzles me regarding such matters. But guess what? He's out on PTO, and my buddy Bob Laffler isn't such a prude. As such, on this episode of GAAP Chats, I wanted to delve into the Donald Trump and Clarence Thomas news cycle, but not from a political point of view. I think that these events can teach us a thing or two about accounting and auditing. It's a leap, I know, but don't you kind of want to stick around and see where this adventure takes us? Especially since Bob and I don't have a script. Welcome to GAAP Chats, the podcast dedicated to all things accounting, brought to you by GAAP Dynamics. I'm your host, Mike Walworth, and with me today is Bob Laffler as Chris Brundrett is on PTO. We hope you'll join us on our journey today as we share our passion for accounting and help change the way you train. Well, Bob, welcome. How are you?
I'm doing all right, Mike. How about yourself?
I want to thank you. Go ahead.
I was just going to say, it seems like, probably because it's every time I come on these GAAP chats, that someone's on PTO. It seems like GAAP Dynamics takes a lot of PTO.
I don't know if we've been voted the top places for people to work, but maybe that it does seem like we are on PTO. But in fairness,
good advertisement.
It has been around spring break time, right? So you went with your family spring break. I know Chris took some spring break. I took some spring break. And then now, you and Chris your kids are a little young for this, but now I have two spring breaks, right? Because I got kids in college with an earlier spring break, and then I got my 8th grade daughter that still has spring break. So yeah, it does seem like we're on a lot of PTO, and you have helped out tremendously. If you don't watch out, you're going to have to be a regular, and I'm going to have to relinquish my spot to you. Maybe that's what we're saying.
Let's not get too carried away.
All right. So anyway, today, Bob, I wanted to talk about Donald Trump and Clarence Thomas, specifically kind of, what's going on in the news lately.
That sounds a little dangerous, Mike, knowing you. And also knowing, that these things can get contentious. I'm a little concerned that this might get a little inappropriate for an accounting podcast.
Well, luckily that we have two guardrails. Normally, there's not a lot of guardrails, but we have two guardrails here. One, you're going to keep me on my toes, right? So you're not going to let me delve off into an area where we shouldn't go, politics. But I think too, we if something were to be really wildly inappropriate, we can always edit it, thanks to Clark and his good editing skills.
Okay.
But I assure you, but you don't need to worry about me because I'm not going to really delve into politics. What's interesting is it stems from, or this topic stems from, sort of a discussion that we had last week, I believe it was, and we started to talk about like the Donald Trump hush money payments, and really, what was the problem? That's so I wanted to go there. I kind of wanted to not talk about the man himself, but talk about, kind of the hush money payments and the accounting implications. And I actually didn't understand myself kind of why it was illegal or whatever. Certainly immoral or whatever, but I think it can teach us a thing or two about accounting. And then I'm sort of making a leap here because I do think sometimes these sort of payments, it all comes down to taxes. And actually, and I haven't shared this with you. Just for our listeners, we're going off script now. Bob, I literally grabbed him on and said, we got to record a podcast. He was walking the dog and said, I have no idea what we're talking about today. But anyway, it does sort of come down to taxes. And even this one did. And then I wanted to kind of go into uncertain tax positions. And then I also wanted to talk about Clarence Thomas a bit, and really the concept where I'm going to go, or the leap there, is sort of on independence and kind of what that is. So I do think that they can teach us a thing or two and helpful reviews. So
let's find out. This is exciting.
Okay, so here's the deal. To get everyone up to speed, unless you've been living under a rock, Donald Trump during the 2016 election cycle, it was alleged that he made hush money payment to Stormy Daniels, $130,000. And he didn't make, but the National Enquirer made on his behalf, $150,000 another payment to the ex-Playboy model. And really what it was sort of hush and a non-disclosure agreement, hush money, so that they would not come out during the 2016 election cycle. Now, Michael Cohen went to jail for these payments, right? But individual number one, Donald Trump, did not. Now, part of the reason why they didn't charge him then was he couldn't be charged because there was a Department of Justice thing or whatever. But Bob, do you know why the payments are illegal? Because is it illegal to
I mean,
pay someone to
I
shut
don't think
up?
it's illegal. I mean, no, I think you pay what you pay, and you take it to accounting. I mean, it's all debits and credits, right?
Yeah.
Credit cash, debit, whatever. So, I mean, it doesn't seem like there's any illegal aspect at this point.
Yeah, so what's interesting is I looked into it, and what's interesting is I thought at first because again, the Alvin Bragg, the Manhattan District Attorney, basically says that it's misclassifying expense, falsifying business records, right? That's the underlying charge, and that's normally a misdemeanor. The felony charge comes because they're saying it violated campaign finance reform. That's the leap. Who knows whether or not he's going to get them or not? I don't know, but falsifying business records. So I started to think about it at first, and this still might be the case. I thought, well, wait a second. The company, Trump organization, is paying these this hush money payment. How does that benefit the company versus Donald Trump? So I thought it was initially kind of a personal expense, yeah, being charged through the business, and that's where the misdemeanor charge came. But in reading some of the stories from AP and different things, it's actually a tax thing. It's the fact that, think about it, Cohen paid 130 grand, and then Trump reimbursed him. Cohen paid National Enquirer 150 grand, then Trump reimbursed him, whatever. But you know what he did? Cohen, being, I don't know if he's smart, I wanted to say call the man smart, but Cohen basically said, well, screw that. If you pay me 130 grand back, that's going to be income to me, and I'm going to get taxed federally and taxed from the state. And they're in New York, so it's going to be city local tax too. So Donald Trump, the Trump org, grossed up those payments. The 130 grossed up back to Michael Cohen, and then therefore called it all a legal expense, when in reality it was misclassified to begin with. It wasn't a legal expense; it was a hush money payment, right? So it does relate to taxes, but it got me thinking. And it sort of got me thinking, I don't know, you don't know where I'm going with this. Do you remember, Bob, so we started GAAP seminars in 2001. I started, with Richard. And then you were still, at the time, you were kind of working with KPMG, and then you went to Credit Suisse. But what's interesting, we had our first, the first thing I think I taught in Egypt, but the second training I ever did. And actually, I take it back. This might have been before GAAP seminar. Well, wasn't it? This is when we were at.
Oh, yeah, we were still at KPMG.
Yeah. So remember that, you know where I'm going with this, the trip to Russia.
Mm-hmm.
Bob and I taught in Russia back in the 2000. It was probably 1999 or 2000. We taught like a U.S. GAAP course to a firm in Russia. And Bob, when I bring up that Russia trip, I wanted to kind of go down memory lane here. That was 23 years ago now. What's one thing that stands out to you about that Russia trip? Because I remember it was wild. It still resonates in my mind.
Well, yeah. So there were a couple of famous quotes, and the two that I think I remember most were questions that we received from the participants in the class when we were going through U.S. GAAP and impairment standards and so forth. And then all of a sudden you get the hand raise, and I remember one of the famous questions was, "Yes, I have a question for you. How do you account for a contract killing? I mean, is that an expense?"
I totally forgot about that. Dude said basically his audit client was under investigation or under charge with the contract killing of the CEO of the other. And Bob and I looked at each other, like, mind you, like 23. I mean, I was 30 years old. You were what, 28? And we looked at each other like, where the hell are we? The contract killing.
I just want to answer that. I don't think my training has really prepared me for accounting for contract killings.
And then
whether there's a contingent liability.
Yeah, right. Basically, what it was a subsequent event after year end, but before the financial statements were issued, my CEO was arrested. Is it a subsequent event disclosure? And I was like, holy shit, where are we? And then what was it? You said there was two. What's the second?
Well, and then the second one was, the question about how to account for bribes. How do you account for a bribery?
Yeah, and so just to be clear. Two things. One, bribes, and so the payment for Trump, going back to Trump, the NDA, paying someone for a non-disclosure, is not illegal. However, if the payment itself is illegal, such as bribes or blackmail, that is a matter of criminal law. Specifically, payments of bribes by companies, especially those that are in the United States under the SEC domain, would be a violation of the Foreign Corrupt Practices Act, the FCPA. But I remember, I think I had the best answer to that, because like, how would you account for a payment your company makes to bribe? And I believe my answer was, because again, you said the credit is cash. It's clear. It's the question is, what is the debit? I'm like, other. Just dumping
exactly.
it on, dumping it on there. Yeah. I was like, you're gonna bury that. But the key is
but you need to account for it, because if it truly is a company expense, it needs to be accounted for. So it needs to go somewhere. But I guess that's where the GAAP accounting and the tax accounting kind of come into play, because GAAP says, hey, cash out the door needs to be accounted for. It's an expense. But for tax purposes, bribery is not deductible. I mean, you can't do that, right? That's illegal activity. So somehow then it shows up if you don't have equal expenses on both GAAP and tax books. Well, then what do you do with it?
And so back in, what's interesting is back when we did this in 1999. I don't think the rule for uncertain tax positions had been released then. I mean, it was after it was after our trip. But this would be a perfect example, I think, of what would fall into, and it's something I've used, and I don't know if you use this too. Something I use when we talk about uncertain tax positions under U.S. GAAP. And so the question is, as Bob said, my credit is cash, my debit is other, and it was for a bribe, and it's illegal, and we got a whole host of FCPA violations. But as Bob said, probably I don't want, if I'm trying to bury the thing, if I'm a company, I probably don't want that difference, right, Bob, between book and tax.
That would be a permanent difference.
Permanent difference that would stick out like a sore thumb that I did pay this.
Exactly.
So if I'm going to bury it in other, I'm going to bury that shit deep into taxes too. And I'm probably going to take a deduction on it for tax purposes. But we know that bribes and illegal payments are not tax deductible. And so what do I have to do under GAAP, Bob? What does GAAP say? So GAAP says you got to look at these sort of uncertain tax positions. And, after we identify the position and we determine the appropriate unit of account, the next step is we have to determine if the tax position meets the recognition threshold criteria. And basically what we're saying, right, isn't it, that if the tax authorities knew about this payment, would they give me a deduction, yes or no? And if the answer is no, then you cannot deduct it, and we're going to have to set up basically a tax liability. Now, it's not deferred, it's current tax liability, right? But I'm going to have to set up a current tax liability and debit sort of, current, well, it's non-current, current tax expense, depending on when I think they're going to find it or whatever. Now, I got a question for you, Bob. Does it matter? Is detection risk, does that sort of rear its ugly head in this scenario? In other words, I buried it so deep that there's no way the tax authorities would ever find it. Is that it?
Yeah, like audit risk. Is it likely that they're even going to even see this? I mean, come on, they're not going to look at this kind of thing. I know how to hide my dirty work. Yeah, we'd like to think that was something we consider, but that's part of ASC 470 or FIN 48, as we like to call it. Is you need to look at these positions without any consideration of detection risk, like as if the authorities were aware, did look at it, and were opining on that position, which makes it very difficult to kind of get away from.
So basically what you're saying is the tax authorities see the check, whatever, however much of the bribe is, signed by whoever, payable to Putin, and in the memo line they see bribe. And the question is would they give you a tax deduction for that? And the answer to that is no. Forget it.
So you better put up this tax liability.
You put up this tax liability. Now, sometimes it isn't yes or no. It's not black and white like a bribe, right? So give me an example of when a tax position could be sort of questionable. Like, in other words, it's not that we're not questioning whether or not it's deductible. It's more or less the amount, because that can happen too.
Yeah, I mean, one of the common things that we would see, the example that we use a lot of times in our training, is sometimes you have kind of intercompany licensing and stuff like that, where basically, the head company has the rights to the IP or the trademark or whatever, and they essentially will do some, transfer type of cost for the license of that right. And therefore, how much can you really charge for an intercompany, license of your trademark or your IP? And sometimes tax rules have some gray area as far as what is a reasonable amount to be able to charge, because you're really charging between jurisdictions, right? You might be going from one tax jurisdiction to another, where you're trying to hit the expenses of the high tax rates and get the revenue on the low tax rates. So there's a lot of that kind of shenanigans that goes on, and that's a gray area. And it's not illegal, right? We're not talking about bribery where obviously that's illegal. It's a legal arrangement. It's just a question is what is the amount that you can actually
So
get.
what you're saying, so let's go back. So, we do a lot of training in the Cayman Islands, 0% corporate tax rate. If I'm a company and I have, all these jurisdictions, it would benefit me, or Ireland is like, what, 10, 15%, I think it is. So it might benefit me to have my revenue in a lower tax jurisdiction and have all my expenses in Germany, which is a higher tax, thing, right?
You put your head office in the low tax rate jurisdiction where they have the rights to the IP and the property, and then they charge the crap out of the higher districts where you're actually selling your product and therefore reducing the revenue there, increasing the revenue in these home countries,
And so what you're saying is the tax
shifting tax
authorities,
income.
the tax authorities could say, listen, I understand that you got to charge some of this IP. You said IP for a trademark or whatever. I understand you got to charge it, but you charge through X. And I think it should probably be X minus something, not as much.
Exactly.
And so you have a question about the amount. Now, in that case, what does GAAP say? Like, let's say, for book purposes and for tax purposes, I tried to go for the full Monty, right? 100% of this stuff in the higher tax jurisdiction. But what does GAAP say then about sort of figuring out the amount that for uncertain tax positions?
PCAOB inspections and the associated inspection reports can bring stress to audit engagement teams everywhere. If you want to improve your team's audit quality and reduce the number of potential deficiencies in your reports, GAAP Dynamics can help. Join us for our upcoming webinar, Improving Audit Quality, on Tuesday, April 25th, 2023 at 11 a.m. Eastern Time. It's free to register, and you'll hear directly from PCAOB inspectors about risk assessment, internal controls, supervision, and review. And the best part, you can receive up to 1.5 hours of CPE credit. Register now at gapdynamics.com. That's GAP with 2 A's, dynamics.com, or simply click the link in the description. Hope to see you there.
Well, so the threshold is you've got to get the amount that's more likely than not to get accepted by the tax authorities, but you need to take the highest amount that is more likely than not to be allowed by those tax authorities. So it does require you looking at what's all the different scenarios, right? And then what's the highest amount that I can justify is more than 50% likely to be accepted.
And I think too, one of the things that when we used to teach a lot of the GAAP differences, and we'll go into Clarence Thomas here in a bit, but we used to teach a lot of these GAAP differences. This was one of the main differences. But IFRS now, I think is it IFRIC 15? Was that the one? Am I thinking the right number here? They have something on uncertain tax positions too under IFRS now.
Yeah. Yep. I think it's 16.
If 15 or 16.
16 is one of those.
Yeah, don't quote me on it. But again, I think uncertain tax positions is one of those areas in GAAP, whether it's US GAAP or IFRS, that does give people, some trouble. And so I thought that was a good sort of tee up. And then there's, you got to calculate interest and penalties and then all these disclosures. But just remember that if you're making these payments or if you're doing these sort of charges to intercompany, or even I was thinking even a simpler one, right? Even like meals and entertainment. If the entertainment is you weren't talking business, the tax authorities couldn't come back and say, or like here, perfect example, our annual meeting for GAAP Dynamics. We did stuff, but we're talking annual meeting. That's an internal meeting. That's 100% deductible. But if I'm doing entertainment, that's 50%. And so the tax authorities could question that too. That's another sort of simpler example than sort of intercompany IP.
Yeah, we're aging ourselves. It's IFRIC 23.
Oh God!
Mike, so.
Thank you, Bob, for looking.
A few IFRICs have gone since.
Oh my God! I don't even. Oh, that is IFRIC 23 is right. That is definitely one. Well, thanks for looking that up. So now let's sort of segue into Clarence Thomas, and basically the story here is that for years he's friends with a high-powered Republican donor, right? And this donor took he and his wife, Jenny, on trips, and these trips were luxurious. So, like, it's funny, I was listening to some podcast about Clarence Thomas. He sort of normally takes trips in an RV, and he's like one with the people, and he has all these in campgrounds talk. But it turns out that was just his personal trips that he had to pay for. The ones with the Republican donor, literally these were $250,000 trips, right? Flying on private jets, whatever. and he didn't disclose it, and that's sort of something that's coming up.
This takes me back, Mike, to remember the days when we were working for the Big Four, and our clients used to take us out on those big trips. Like I remember going on those private jets and going on those vacations with our clients. That was right before audit sign off, if I recall, where they would say, you guys have been working hard. Let me take you out to a fancy dinner and show you a good time before that audit report needs to get signed.
Well, you and I grew up at the same firm. I don't know what the hell you were talking about. First of all, if there was any whining and dining, it was probably us whining and dining the clients, right? Because we had an expense sort of thing, and we would take them out on golf trips or whatever. But that was still I'm dating myself here. That was still pre-PCAOB.
Sure. Yeah. And there were limitations on what we could do, right? We still couldn't kind of, be taking advantage of the private jets and the golf memberships of our clients and so forth.
Yeah, no. And what's interesting is again, I am not alleging that Clarence Thomas did anything wrong, right? I think what the issue was, he maybe didn't disclose it. And the question is maybe there should be independence rules for Supreme Court justices that there are for accountants. And so if we go now, the independence rules for accounting, there's independence rules for the AICPA, so US GAS, there's independence rules for the PCOB, there's independence rules for the SEC, and then each firm has their own independence rules. And, one of the main things is that, if you were sort of, and I think I got this from the AICPA Plain English Guide to Independence, it basically says when you think about independence and CPAs, you need to have an independence of mind and an independence in appearance. So it's like fact and appearance.
Body too. Independence of body, mind and body.
I don't know if
spirit.
I don't know if it's that. So basically the PCAOB rule states auditors must be independent of their audit clients throughout the audit and professional engagement period. It also states that auditors have an obligation to satisfy all other independence criteria to the engagement, including the independence criteria set out in the rules and regulations of the SEC. And so when we look at some of the main things, right? An auditor cannot function in the role of management. An auditor cannot audit his or her own work. An auditor cannot serve in an advocacy role for the client. And the auditor cannot have a mutual or conflicting role with the client. And so an auditor is not independent of the client if the auditor maintains or prepares the client's audit accounting records, prepares the client's financial statements that are filed with the SEC, or prepares or originates source data underlying the client's financial statements. And so really what we're saying now, so when you and I worked at the accounting firm, and mind you, we still do work for accounting firms, and we still have to sign off on independence, right? Rules. Absolutely. For the Big Four. And so basically they want to make sure that even their vendors, us, the GAAP Dynamics now, is independent, and that we don't have a financial interest in a company, serve on the board, serve in management or whatever. And so, but it goes deeper than just stocks and what stocks you own or what board.
Sure. I mean, if there's one thing I remember, Mike, I mean, the thing with the independence that really resonated with me was, there are all these rules, like you say, but at the end of the day, you need to be independent in fact, i.e. you don't have any kind of independence violations, interrelations and so forth. But the biggest thing, and the one that really just kind of captures everything, is this idea of being independence in appearance. Because at the end of the day, as an auditor, you are acting independently, verifying financial statements, saying they're okay. If a shareholder or any outsider were to look at you and get the sense that maybe you're not an independent body from the company itself, then the biggest thing that public accounting has going for it, which is trust, is lost. And therefore, those rules are really strict to maintain that independence in appearance as well as independence in fact.
And that's, and they have in all of the firms. Well, it's interesting. All the firms have these sort of independence databases set up, and they have I think, because didn't one of our buddies, who I'm talking about, partner one of them, but basically he now is working on the independence arm of the firm, a guy in Richmond, one of the partners in Richmond, played basketball with you. But anyway, he's now working for the independent. So I guess my point is these Big Four firms have, departments set up to make sure they don't run amok.
It's a big deal.
Of this independence. And then, and obviously also for Big Four, where they've gotten in trouble over the years is when they start doing some of these consulting work. And that's why, and we saw recently EY wanted to split off, but that's one of the reasons why they wanted to split was because the consulting arm was losing out on 25, 30% of the market because they were an audit client and they couldn't do anything for them. But anyway, so that brings me to a story, and this will probably be the final. I don't know if you remember this story, Bob, but when I was working at a Big Four firm prior to going to Switzerland, it was an audit client of mine, and I had sort of taken over the manager responsibilities, and it had been a client of ours for a period of time. And so as a new manager, I sort of assumed, maybe wrongly, that the accounting was, I didn't have to go back and look at their accounting policies to make sure that they were correct, right? I mean, they were the ones that saying, this is how we account for things and whatever. And so long story short, I get a call one day. And so again, I was sort of taking it over, and I get a call from someone, and they said, hey, excuse me, is Mike there? And I'm like, well, this is he. And she said, hey, I got a question. I'm the auditor of XYZ company, and I see you're the auditor of ABC company, and you account for beneficial interest in securitizations this way, but I've been told I'm not allowed to account for it that way. And this was back in the days, there was some discrepancy in accounting, and I guess half the industry was accounting for it at mark to market, half the industry was accounted for it because it was a beneficial interest in loans that had yet to be securitized, so it wasn't in security form, and so they were accounting for it at low-com, like a loan. And so there was some discrepancy in accounting, and the first thing she said was like, oh my God, you're doing it fair value, and my client and the head of the accounting practice for this firm said, you're supposed to be doing it at low-com. And I was like, oh shit, I don't want to talk to this woman. Goodbye, la, 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 I can't hear you. So anyway, I tried to put her off, whatever. Long story short, she came back, and, it turns out that my client had been doing it wrong. And I was like 2 months into it, but had been doing it wrong for 2-3 years. And there was a restatement, and it was a big R restatement, right? Go back and restate the previous year. And I remember during that time, there was discussions between the firm's head of the firm's head, accounting department, and then my client, the CFO and controller. And I remember I was trying to, because at the end of the day, they're questioning the client, but they're kind of questioning. I mean, I look bad in this. I'm like, well, I had it wrong, even though I had not. Well, I didn't sign off as a manager, but I was only an interim, so I guess I was safe there. I hadn't gotten that far yet to issue a report under the old rules as a manager, but I'm just trying to cover my ass right now. But anyway, at the end of the day, it turned out that they were wrong and they had a big R statement. But during that time, I was sort of on the calls with the firm's head of accounting and the client's head of accounting, and I had. You know how I get, Bob. I mean, I have Mike specials.
I think we all know how you get. Yeah.
I have PowerPoints. I had industry analysis and how 62% of the markets were doing it this way. Long story short, I did all this stuff, and I had this big meeting. This was the big brouhaha. Do we restate or don't we? I ended up restating, and again, I sort of had all this stuff. And again, I had these presentations, and I remember when I got back to the audit room, I got a call from the head partner of the head of the firm's accounting. He asked me, it's Mike? Yes, this is so-and-so. He's like, let me ask you something. I'm like, yes, sir. Again, I'm 27 years old at this time. I mean, yes, sir. He's like, who the F do you work for? And it took me aback. Now mind you, we're not in today's we could cuss back. I was like, pardon me? And he's like, who the F do you work for? And I'm like, I think I still work for you. I didn't know I was fired or whatever. And he's like, you're damn right. And don't you ever effing forget it. But what he was saying is, but it was a learning lesson for me. And it was one, I don't regret that dude. I mean, at the time I thought I was a 27-year-old punk. I thought he was a jerk. But now that I'm in my 50s, I sort of appreciate it, because what he said was, one of the things of independence is you don't serve in an advocacy role for the client. And essentially, during that meeting, I was the defense attorney for the client's accounting. I mean, I had all the shit lined out. Like, me and the client were working together to prove that this was the right accounting. And he pointed to it was totally true. We are not, as auditors, basically, it's not our deal, right? Management is responsible for the financial statements. Management is responsible for the reports and their accounting policies, not me as auditor. And so I always appreciated that guy. And as I look back and I get older, I always appreciated that guy. And you knew him too, kind of later in life, didn't you?
Yeah, I ran into him in Frankfurt when I was working on a project there. And, he was a big shot partner with in charge of the overall project. And let's just say had a late night, and he went home early, so we decided we would just stay out all night and then go to have breakfast on his name at his fancy hotel in the morning after an all night clubbing. So that's probably a story for another podcast.
Yeah, and I also heard later. I mean, again, he also, I think, he found out you were from the office and he knew me, and he's like, that guy? He seems like a real piece of work. So anyway, but later in life, I think we made up, and I think he
all worked out.
He's appreciated. But anyway, Bob, I think that is it. I think we've kind of gone through independence, and we've gone through the uncertain tax positions.
So to summarize, I guess we figured out that Donald Trump might have a FIN 48 uncertain tax position issue with his GAAP financial reporting if he were to do such a thing, and that Clarence Thomas, if he were an accountant, would have an independence issue. But he's not. He's just a Supreme Court justice who apparently has different independence standards.
And we should be advocating for independence rules for the justices, I think. Bob, why don't you take us out?
Okay, that's all for the episode of GAAP Chats. Your source for all things accounting. Notes and resources from today's episode are linked in the description. And as always, you can find us online at gapdynamics.com and at gapdynamics across social media. It's never too late to become a gapologist. Head over to our website and subscribe to our blog so that you're the first to know what's new with GAAP Dynamics.